it raised interest rates by 25 basis points. It was a unanimous decision. Interestingly, it was they did consider a pause following the recent stress in the banking sector, but the Fed was also adamant that it does not see rate cuts this year, disagreeing with the market, and we'll get into that later today. Its terminal rate projection remained unchanged at 5.1%. But interestingly, the Fed did change its language slightly in the statement. Gone was the reference to the Fed anticipating ongoing increases in the target range, and now that's been changed to the committee anticipates that some additional policy firming may be appropriate. And in a funny moment at the press conference, Powell said that he put emphasis on some and the may. So that's just something that was quite interesting. With all that said, Powell said that the Fed will remain quote unquote data dependent, and it will be prepared to keep tightening until inflation cools. So that's the recap. Now to the analysis. Enough talking from me. Greg, Ryan, what did you both make of the decision?
Well, perhaps I'll kick off. I was a little bit surprised by the decision. I think when we spoke last week, I thought the Fed might go on hold, given that there was a fair bit of financial instability at the time. They've clearly thought that ring fencing that problem in terms of stopping depositor outflows and stopping a banking panic allows them to focus back on the inflation issue. And in Powell's comments today, he initially talked about those banking issues, but then immediately started to address the inflation concerns. And I just jotted down the first sentence he said is, inflation remains too high and the labour market continues to be too tight. So that is clearly their overriding focus to get those things under control. From my perspective, they are looking at lagging indicators. So, the high inflation, if the slowdown that we've seen over the past couple of months continues, and there's every bit of evidence that it will be, inflation will continue to come down. Now, the Fed is going to continue to tighten into that inflation coming down, but the inflation is a lagging indicator. So by the time they've seen the inflation come down to where they want it to be, they will have tightened way too much. And if you look at, and I always like to look at how the market reacts. And initially, when I was watching the press conference, the market was rallied a little bit. Then into the close, it started to sell off quite heavily. And I don't know whether that was comments from Janet Yellen, which we can talk about a bit later. But I looked at the US indices afterwards. Every single stock in the Dow Jones Industrials was down. In the S&P 100, which is the 100 largest stocks in the US, 97 stocks finished down on the day. In the S&P 500, 490 stocks finished down on the day. The S&P 500 financials finished down 2.2%. The real estate index was down 3.65%, and consumer discretionary was down 2.23%. So they all vastly underperformed the S&P 500, which was down about 1.65%. So to me, that's suggesting the market thinks, okay, the Fed is continuing to tighten, continue to focus on these lagging economic indicators, and it's going to cause an economic slowdown. And on the other side of the coin, the fixed interest market, if you look at the bond market, 10 yields finished down 16.5 basis points, and the 2-year yield was down 23 basis points, which suggests the bond market is looking at that and saying, the Fed, you're going to cause a sharp slowdown. Money's going to go into fixed interest. Inflation and interest rates will come down no matter what you say.
Yeah, and I think that's the disconnect maybe between what the markets think and what the Fed are saying they'll do, which is playing out right now. And I think I read an interesting stat just a few hours before the decision saying that 80% of like big bank economists thought the Fed was going to rise 25 basis points, which they did, but only 50% of them thought they should do it. So they thought they were going to do it no matter what. And I think that comes down to the fact that if the Fed paused, which I think I thought they should do as well, it would look like the financial situation was worse than what they want people to think it is. You know, it sort of amplifies the banking crisis, because it was only the last meeting that people were thinking the terminal rate might be even higher, might be closer to 6% than 5%. And the Fed were adamant back at that last meeting that no, we're going to keep on increasing rates throughout the year. So for them to go to a pause or or even decreasing rates would have been maybe panic the market more than just raising 25 basis points, which is what they ended up doing. So I think some aspects of it was just psychological, to be honest. I think it was just we don't want to like show that we're spooked, so we're going to raise 25 basis points, and then let's see what the next month brings. And to give you an example of when they've done that in the past, when Lehman Brothers went bust in the GFC, the Fed kept rates on hold the meeting after that, and that was a big deal at the time as well. But the Fed didn't want to look like they were panicking, so they paused. I don't think they were in such a big increase cycle at that point. So I think the pause was just to show that they weren't panicking. But I don't think it necessarily indicates too much about what they think the future economy is going to be like. I think the plan all along, because you've got to remember, these were the fastest rate rises in history. Like the pace of these rises has been extreme. And I think the plan all along was to raise until something broke, which seems to be happening. And now the next phase of this is to see if they can contain it as much as possible to the financial arena, while still having some effect on the real economy to try and bring down inflation. And this is a very, very tricky thing to try and do. And I don't think they'll be able to do it. But I think part one of the plan, raise until something breaks, is here. Now, for the next month or so, they'll see if they can contain it. But I don't think anyone really knows what will happen after this, to be honest.
But that example you just gave, Dinse, sorry, Kiryll, it just shows that the Fed hasn't necessarily learned from those decisions. It was still looking back, because in 2008 at the time, inflation was quite high because we just had a massive credit boom. And as I said, inflation's a lagging indicator. They were looking back thinking, okay, we don't necessarily need to cut, whereas the market was looking forward and seeing a massive credit contraction. I'm not saying that we're in a similar situation now. All I'm saying is that the Fed's still continuing to look behind them in setting policy rather than looking forward. And I agree, they're in a pretty tough situation. If they would have gone on hold at this time, there is still, a lot of that liquidity that they created in the COVID years. Their balance sheet doubled from around 4 trillion to nearly 9 trillion. And there's still a lot of those reserves in the system. So they did risk unleashing more speculative spirits. And I think now they're in the process of saying, people can't or shouldn't rely on the Fed put anymore. We're not there to support stockholders. We're there to crush inflation. And I think that, if they keep going down this path, they certainly will do it.
Yeah. And I think you both mentioned that there's the disconnect now between the Fed's view of the terminal funds rate and the market. So I wanted to get both your views on, why is there such a big disconnect, and what could it potentially signify?
Well, just quickly, I think, Greg, from the data I looked at, I think I could be right in saying that the future funds rate is pricing in, lower funds rate from July onwards. So it's pricing in pausing or cutting from July onwards, which suggests to me that the people, you've got to remember the people investing in these futures that are people putting real money on the line. So to a large extent, I believe their opinions more than I believe the Fed, which is trying to manipulate people into acting a certain way to some extent. And they're looking at the data and seeing that there are cracks in the real economy happening. So right now, the banking crisis is a crisis of liquidity, banks freezing up and not being able to, honor deposits and stuff like that. But that's sort of like this financial abstract construct, which the Fed is sort of managing in different ways. But there are actually real cracks in the economy caused by those extreme rate rise increases. So, for example, a stat I read here said that corporate defaults worldwide are emerging at their fastest pace since 2009. So that's the corporations defaulting on debt. There's another a stat here that I read related to the commercial real estate sector, which I think is a real area of big worry, that said the delinquency rate in the US $3 trillion office sector rose to 17% in the first quarter of this year from 12% at the end of 2022. These are big rises. These aren't incremental rises. These are big rises. And you've got to remember, commercial real estate and commercial loans, that affects the banking industry hugely, because this then turns this from a liquidity sort of, plumbing issue into an actual credit crisis, a credit issue. And then you're talking defaults. And then that means job losses and all the flow-on effects from that, businesses going bust. And to be honest with you, that is predictable to a degree. You don't go from like interest rates close to zero to interest rates close to 5% in a very short span without smashing a lot of business models in real estate and property and lending in tech and everything. And I don't think the Fed maybe realizes, or maybe they do, maybe their idea is to smash things, but I don't think they can manage the extent of how badly this might play out in the real economy. The timing of that is uncertain, but that's what I think the futures market is looking at. They're looking at the real data. As Greg said before as well, there are early signs, or there's decent signs in real world data showing inflation is coming down anyway. You know what I mean? Inflation, auto sales are coming down. There's actually a lot of delinquencies in auto loans starting to emerge as well, which is another sign of people, defaulting on their car loans, which is also another sign of stress in the market, which again feeds back into banking because car loans going bust, there's not much asset value in a car loan going bust, and that can really hit banks badly. So I think there are signs. Yeah.
I was going to say to that point on real estate, just going back to what I said earlier, the largest sectoral fall in the market overnight was the real estate sector fell 3.65%. Banks is the next largest fall, and they are connected because a lot of those banks, not necessarily the big, JP Morgans, but the next rung down, your middle sort of banks have a lot of commercial real estate on their balance sheet. So if commercial real estate's falling, that's going to put pressure on the banks. And especially if you've got your deposit base moving into money market funds, moving into the bigger centered banks, that just puts more and more pressure on them. And then the flow-on effect from that is that those banks pull back on their lending, constrain credit to the economy. That's going to lead to a further slowdown. So in answer to your question, Kiryll, why is the market pricing in this and why is the Fed saying this? The Fed's looking backwards and the market's looking forwards. It's as simple as that.
That's a good point. Sorry, Kiryll, I just want to jump in quickly because First Republic's in the news a lot at the moment as a bank that's, up and down like a yo-yo. I think it was down heaps a couple of days ago, then it bounced back yesterday, and I think it's fallen again today because Janet Yellen, as you said at the start, Kiryll, just when Jerome Powell was speaking and trying to reassure markets, Janet Yellen came out again and said that uninsured deposits weren't going to be guaranteed. And a lot of these some of these regional banks have a lot of uninsured deposits. And that caused a huge scare through the regional banking sector, which again, doesn't have issues just with uninsured deposits, but it has issues with a larger sort of exposure to that commercial real estate sector than the big banks might do. And the interesting thing there is, and this is why it's the Fed are always trying to put out different fires that emerge in different places, is that people like JP Morgan and that had a lot of US treasuries and stuff like that are now pretty much they can access the value of that through the sort of a BTFP program that the Fed put in. But banks like First Republic didn't have as much of those US treasuries and mortgage-backed securities. They actually had real lending to real customers. But the flip side of that is that they can't now access that facility if there's a run on deposits because that facility only covered US treasuries. It didn't cover normal day-to-day lending. So banks doing real lending in the economy, smaller banks and mid-sized banks, are probably going to be hit a lot harder so far because there's question marks on what facilities they've got for liquidity. There's question marks on uninsured deposits. So that is the real economy in a way as well. That's more representative of the real economy. A lot of the big banks are representative of the financial economy in a larger degree as well. So I think this is the problem of a centrally managed, this is a bit esoteric, but this is the problem with a centrally managed monetary system, is that you've got one small group of people trying to manage various aspects like inflation or like something else without letting the market do its job. And they fix one thing, but it just causes something else to bubble up over here. And then they're trying to fix that thing. And there's all these unintended consequences and second and third order effects that play out. And I think that's the problem that will gather, steam over the next few months.
Yeah. Well, interestingly, in the conference, Powell did actually mention the tightening credit conditions, and he sort of said that the tighter credit conditions can actually act as a substitute for rate hikes, in his own words. And I just wanted to maybe, if both of you could elaborate on that and what you think of that, and maybe, are we likely to see tighter credit conditions from here going forward?
Well, there's two ways to look at it. You can look at the fixed interest market as a form of monetary easing. So when interest rates fall, that is generally considered a sign of easing financial conditions. But on the other side, you have to look at the spreads between your risk-free rates, which is your government bond yields, versus investment-grade debt and other forms of debt. So if those spreads are tightening, then that's considered, financial conditions are easing. If those spreads are staying quite wide, then that is, potentially tightening. The other area to look at that doesn't necessarily show up straight away in the data is the ability or the willingness for banks to lend and to create credit through lending. So the last time I looked on the Fed's balance sheet, I can't remember the exact figure, but commercial loans made by commercial banks, the commercial banking system, which is where money creation happens in the first place, has been falling all throughout 2022 and has continued to fall into 2023. As I said, I can't remember the exact number, but it's something like at an annual rate of probably 2.5%. It was around that level. That is going to continue to get smaller. So if your banking system is creating credit at such low rates, that's I guess a de facto financial tightening. There's not a lot of credit being created, which suggests there's tighter financial conditions because banks and loan officers aren't seeing the conditions to say, yes, we accept that risk of that loan. So I think you're going to see more of that in the future. And I think what Powell was saying is that these issues that we've seen in the banking system over the past few weeks are going to lead to exactly that. But that's good because then we don't have to raise rates as much. That'll still do our job for us. So on the one hand, he was saying, we're going to tighten one more time, be data dependent on whether we continue to do it. But we're being given the flexibility to do that because there is this credit tightening happening in the economy because of these banking issues.
Yeah, I know something I saw in the AFR this morning that just it was a note from Australian regulators saying to big super funds and that they need to revalue their unlisted assets, which are generally property assets and things like that. And that's because sometimes in these super funds, the assets are kept at a certain value, maybe artificially higher because they're not marked to market every day. They're unlisted. So it depends on the investment manager revaluing that from time to time. And a lot of super funds, I remember in the GFC when I was an advisor, a lot of the industry super funds wouldn't revalue them for big stretches of time because they were waiting for the valuations to hopefully come back up, whereas the listed property sector was diving fast. So it artificially inflated the returns. But anyway, my point is the regulators in Australia are asking these funds to revalue these unlisted assets because they know they'll be lower. And then let's think about how that flows on into the banking sector and lending. If you've got properties that have got loans against them and these properties are all going to have to get revalued and are going to be worth less because interest rates are higher, and that's just the way it works, it's going to be harder for small, medium size, and even big businesses to get loans that they might have thought they could get based on the asset values that they've got. And you've got to remember, banks are very conservative. Usually they want an asset to lend against. They don't generally give out, unsecured loans in the medium business sector. But even at the higher end of things, people still like to look at the balance sheet and the assets on the company. So if asset values are going to fall because interest rates are risen, and at the same time, as Greg said, the spread between that risk-free rate and the amount that banks are willing to borrow at is increasing, it means we're going to have a big tsunami of corporations looking to refinance debt over the next 12 months at much higher interest rates and finding it harder to find willing lenders because of whatever the value of their assets are. So these are the sort of things that are coming to the real economy. And I think my thinking on this over the last few weeks has been, well, most economic crises start off in the financial sector and they start off with financial crisis and they then become economic crises later. And I think that's the big issue the Fed's got at the moment is even with doing nothing from now, are we too far gone along this interest rate? Because as Greg said last week, there's lagged effects that are going to kick in. Are the lags already at this level interest rates going to be a lot more detrimental to the economy than maybe the Fed realizes? Because you've got to remember, there's a huge amount of debt in the system these days anyway. We're not back in the 1980s where the debt to GDP ratio in America was a lot lower. It's a lot higher these days. The US government's debt situation doesn't look even that good either. And there's even, all the usual debate about the debt ceiling coming up in July, whether or not the US will raise their debt ceiling, which they always do. But it puts a focus on the US debt situation as well. And that's even a big issue. So, there's a lot of potential negative real world effects going to flow through in the next few months, no matter what. And I think that is, I think today is the start of the pivot from the Fed, or at least the pause.
Yeah. Well, I think you both mentioned the tightening conditions and Powell was asked at the press conference about the recent balance sheet expansion of the Fed to prop up the banking system, and he did try to distinguish the recent expansion from, for example, the QE expansion during the pandemic. So do you buy that distinction, or, and what should investors make of the recent expansion in the Fed's assets? Because I hear that you two disagree on this potentially.
I'll let Greg probably explain what that means, because I think it's the financial system's that convoluted and it's hard to understand what does QE mean. And I think I've been watching debates online between various PhD economists that can't agree on this. So I don't know how valuable me and Greg arguing about it will be. However, Greg, explain what it means, and then we can see where the disagreement might lie.
Well, I'll explain what I think it means, and then we'll see where we go from there. But the way the way that the Fed sees QE is that it is a mechanism to lower long-term interest rates and transmit liquidity through the economy, through the financial system, to lower rates and promote more lending and more economic activity. And they do that by going into the market and buying treasuries or mortgage-backed securities, and they put those treasuries and mortgage-backed securities onto their balance sheet as an asset, and on the liability side, a bank reserve. And that is effectively cash within the financial system.
So they buy the treasuries off the bank.
Yep.
The bank gives the Fed the treasury, and the treasury gives the bank the cash, basically.
Exactly. And then that cash stays within the financial system. It's not necessarily cash that goes into the real economy, because we saw for 10 years post-2008, constant QE, which never translated into any burst of inflation. We had constantly low inflationary period throughout that whole time. So that's QE. A lot of people have, I guess the defining characteristic of QE is balance sheet expansion. And I mentioned before that the Fed's balance sheet post 2020 COVID went from around 4 trillion to nearly 9 trillion in a matter of a very short space of time. Massive QE, massive balance sheet expansion. They bought treasuries from banks, and they effectively funded massive fiscal stimulus by the US government as well. The latest round of QE or not QE is a balance sheet expansion, but in my view, it is very different from QE because they have created, their discount window has been a facility for a long time, and a discount window is there for banks that have short-term liquidity needs and have very good assets that they can post at the Fed to get that short-term liquidity. So what's happening, and the big number that came out last week was, the Fed's balance sheet's expanded by 300 billion, QE's back on. The difference being this form of QE, when you post collateral or an asset, which is generally a treasury security, you're paying, and you're getting cash in return, you're paying the Fed 4.75% for that privilege to do so. It's not free money. You've got to post the collateral and you've got to pay an interest rate in order to do that. So it's not something where, and if you're looking at a treasury security that's yielding 1.5%, 2%, 3%, it's not in your interest to do it. So bank margins are going to be, and when I say margins, it's the net interest margin, the difference between what they earn versus what they have to pay out in terms of their balance sheet assets and liabilities. And that's the primary profit driver of a bank. It's net interest margin. So if banks are having to post collateral at the Fed to gain short-term access to liquidity, that is not quantitative easing. That is a Fed acting as the lender of last resort to provide liquidity to financial institutions that are in short-term need of liquidity, and that is very different to QE.
Yeah, and look, I've been thinking about it over the weekend, and I can sort of understand your point better. My pushback against that falls into the realms of, it's not central banking 101, this, which I know to a degree it is, but you've got to remember they've taken assets that were 50% less, and they've lent against them at par.
Not necessarily. They're only taking assets that are good quality. So treasury securities, and they might be 10, 15% down from par. So they are lending against par.
But what I'm saying is they're pushing the envelope away from what was done in the past. And this is what tends to happen in every crisis. The Federal Reserve goes one step further than what they've done in the past. So whether that's negative interest rates in Europe, recently, or whether it is taking an asset and lending against that at par, even though it's worth less. That is a step further than what they've taken before. And my pushback is that, okay, it might not be injecting new money into the system now, but ceteris paribus, all things equal, it's injecting money into a system that wouldn't be there otherwise if you let the market react as it should. And then my other point would be is I have read some reports from some hedge fund traders and stuff saying there is a bit of arbitrage opportunity, even at a 4.75% interest rate. Like, for example, some mortgage-backed securities are paying 6%, and they're guaranteed by the government as well. So it's an easy profit thing for the bank to take the 4.75% loan, use all your treasuries, doesn't matter what they're worth, you get the par value, so you don't even get the market value, you get this, and you can put that into mortgage-backed securities paying 6% until the arbitrage is, until enough's been bought that the arbitrage comes away. So there's this sort of rule making on the fly that always seems to happen, and it benefits some people and it doesn't benefit others. And if this facility was available a few weeks ago, then Signature Bank, I don't know about the other two, but Signature Bank probably would be fine for now. So what I sort of rail against is the arbitrariness of it all, and the sort of choosing who, when and where it happens. It distorts market to the effect that it's not a game of there's a level playing field and everyone knows the rules. It's trying to guess what the rule makers will do with the rules constantly as an investor and even as a depositor. At the moment, there'll be a lot of depositors in America going, is my bank insured or not? They're saying it's guaranteed, but Yellen's saying it's not insured. And it might not be today. Your bank might go bust. And then next week, they decide to insure all deposits or whatever they do. That's my sort of thing against that. Whether or not it's QE, I understand the important point you're trying to make, which is, is this going to, everyone that says, oh, this is QE is thinking, all right, we're going to get a massive pump in stocks and risk assets again because it's the same as last time. And I understand what you're saying. Well, it's not really that. It's more just trying to plug a gap using a mechanism. But my point would be is the unintended consequences of that are the thing that always catches people out. There's second and third order effects. Giving another example, insurance companies are massive buyers of these treasuries as well and different financial instruments. How does this distort the yield curve, given that one big financial player can do something that another industry in the same industry can't do? Does that distort the supply and demand of these assets, or do they have to change it up? So that's sort of my beef with it, is that I don't know if it's QE or not. And the other point would be is they did things like this in the start of the GFC, where it wasn't QE at the start and it turned into QE later. It was the first rung of QE. And I think that from what I've read, that happened in 2019 as well, when they were trying to similarly, pull the balance sheet back. And at first there was some disruptions in the repo market, and they said, no, we're just going to inject liquidity, so it's an orderly market. And then that turned into some form of QE later on as well. So some of these things might be a precursor, even if they aren't now, to an impending change in the Fed balance sheet.
Yeah, well, let's see where they go. I mean, if they start to accept commercial real estate at par value, then we know we're going down a slippery slope.
And even look, even if they turn around because the regional banks start, collapsing tomorrow and looking like some altcoin crypto on the share price, what happens if they do turn around and say we're going to underwrite the entire, 22 trillion or whatever it is deposit base of the US banks? How does that change stuff? Where does the moral hazard come in there? How does that
You want to own gold and Bitcoin at that point, I'd say.
Correct, yeah. But it's not QE technically, is it? Because they're not paying out any money. They're just standing behind it. But you do know implicitly it is a huge change in how money is derived and what money actually is. So some of these things are more like, this is why I think there's a lot of debates around this, because some people are looking at it technically and usually they're right for the moment. Other people are looking more philosophically at is that fair? Is that right? And then other people are trying to look two steps ahead and say, well, where does this lead to? And I think that's why you get some arguments around some of this stuff.
The only thing I'd add to that is the old "is that fair or is that right" argument. I would say that doesn't exist in financial markets. Nothing really fair, and money is amoral. It doesn't follow rules. It doesn't care. It doesning have any morality or ethics.
Correct. But my point is money doesn't, but the people who are governing our money are picking and choosing winners at the moment, because the timing of these different facilities can mean a company doesn't get it and another company does. The analogy I would give you is that, you've got two shop fronts next door to each other and one's on fire, and the authorities say, too bad, you should have got, a fire brigade to protect your house. that the second shop goes on fire and suddenly everyone panics and they send someone to put the fire out, but the first shop front stuffed. I think what all this, manipulation and different rules and arbitrary decisions does is it focuses people on aspects like that. So not what is money fair or not, but are the people setting these rules at different times? Are they, whose benefit is this? There's a lot of people saying that Silicon Valley Bank shouldn't have been bailed out, for example, and it was just bailing out big tech donors to the Democrat Party. And this is this kind of worms that I think is being opened up. And most of the time, that kind of worms is shut. But in times like this, it becomes open, and ordinary people that might not pay much attention to this realize weird things about money that they've not thought of, like the fact that money in a bank might not be safe and might just be an uninsured loan to a bank that's going to, go nuts and try and make a lot of money from you.
Yep. Yeah, exactly. I agree.
Yeah, well, that was a very interesting philosophical discussion, but I think I'd want to maybe switch it now to something more mundane, which is our own Reserve Bank. In its meeting minutes for March, it did say that it's reconsidering the case for a rate pause at the April meeting. And it said that, the pausing would allow some additional time to reassess the outlook for the economy. And now given the Fed's decision early this morning, do you think that the pause at the next RBA meeting is more or less likely?
Personally, I would say it's more likely. I think the RBA was one of the first central banks in the world to acknowledge the lagged effects of monetary policy, and it's something I bang on about all the time. But they at least did suggest earlier, and I can't remember what meeting it was. It might have been late last year, where they suggested, look, we do have to be mindful of the lagged effects of monetary policy. We've raised rates very quickly and quite significantly from near zero, and that is going to have an effect. And obviously, the variable rate interest culture in Australia, as opposed to the fixed rate interest culture in the US, means the transmission's probably quicker in Australia, and they have to be more mindful of that. So with that in mind, and I think if they're thinking that way, then it would make sense for them to go on hold. And if you look at, the last, the last national accounts, it showed that discretionary incomes are falling, and the reason why consumption's remaining high is because we're drawing down on savings, but now our savings rate is at the lowest it's been since 2017. So there are reasons to suggest that these rate hikes are starting to hurt a little bit. I think it was before we spoke, Harvey Norman come out with its results. It's back down to near the July lows, which was the major low for the Aussie market. Was back in June, July last year. Harvey Norman's getting back down towards that level, which is a bit of a consumer discretionary bellwether stock. So I think it does make sense for the RBA to go on hold at this point.
Yeah, not much to add to that, but yeah, I think the key things there is the variable interest rates in Australia. The really high leverage to property markets as well is probably going to have a faster transmission effect in Australia on spending. And at the end of the day, look, if the Fed's closer to pivoting now than they were, last week, then why wouldn't you just wait and see if you were the RBA, given that they've raised a decent amount already? So I think they'll pause at least and just see the lay of the land.
Yep. Well, I think now I want to maybe turn more towards opportunities and the impact of recent events on stock markets in particular. And I think just more generally on the impact on stock markets. What do you think? Does the Fed's decision today change the outlook for stocks, or is the decision in line with the market's expectations?
Personally, I think it's bearish for stocks. And look, you can see that in the response to the market, how the US market went into the close. My feeling is that the US market was hoping to get a bit more of a bone from the Fed. It was rallying into this result, and then when it's reassessed and digested the comments, those stats I gave at the start of the show here, 490 stocks from 500 in the S&P 500 were down. All of the Dow stocks were down heavy, not necessarily huge falls, but just selling across the board. And I think that just translates into an acknowledgement that the US economy is going to slow down. But on the other side of the coin, you've got longer term interest rates falling. And if you translate that into a risk-free rate for how you value equities, then a longer a longer term interest rate falling is actually bullish for equities. But then again, you've got pressure on earnings, which is bearish for equity. So there's sort of two conflicting things. And as far as opportunities go, I think the way you have to look at things in a recession is when times are good, the market has a very long time frame in terms of looking at how it values certain stocks. So when there's no clouds on the horizon, all the market can see is sunny skies. And yes, we're going to value this because we think the next 5 or 10 years is going to be great. So you have these really sort of full valuations. When short-term volatility hits and the recession's on the horizon, all of a sudden the vision just shrinks down to the next few months, and stocks are priced for this cyclical downturn. So if you can sort of look through that and say, okay, these stocks have still got good long-term potential, but we're in a short-term downturn, then you should be buying into that. So a good example right now is energy, right? Oil oil prices have fallen significantly, especially over the last couple of weeks. We mentioned it last week as well. The fact that a recession is now in view is smashing oil and energy stocks, and they're all in downtrends, and they don't look like they're particularly good buying at this point in time. But I think if you've got a 2-year view, the supply-demand situation in energy is so bullish that you have to be allocating a certain part of your portfolio to buying these stocks in a time where they look pretty ugly. And everyone's thinking, okay, well, what's going to be the outlook with net zero in view? I think net zero is not going to happen anytime soon anyway. It's a bit of a pipe dream. And we're going to need fossil fuel energy for a long time. That's not a ideological view. That's just a rational view. We're going to need it for a long time, and these companies will generate significant cash flows. And I think oil prices will be considerably higher in a strong or a recovering economy. And then you've just got other things like I wrote in a report last night. You would think that tech would be under a lot of pressure now. You've just had Silicon Valley Bank collapsing. That's the tech bank. And then when I look at the all tech index in Australia, it bottomed last year and it's been making higher lows, and it's starting to move into an upward trend. So when I look at things like that, I think, hang on, the narrative has clearly got this wrong. There's clearly something else going on. So, and if longer term bond yields are falling, that is beneficial for tech stocks, which have, in many cases, their business models are projected to be X, Y, and Z in 5 and 10 years' time, and not necessarily earning much in the next couple of years. So those sort of stocks are very sensitive to movements in interest rates. So I think there's some opportunities there to look at, which I wrote about to subscribers yesterday. And just in general, when stocks are smashed in various panics, then I think it's time to sort of be contrarian and look and see whether those assets are worth more. I mean, there was a stock I recommended yesterday. It's down 50% from its highs. It owns world-class strategic assets that can't easily be replicated. It's things like that where you've got to sort of put your fear to one side, knowing that the environment's not particularly great in the short term, but the market knows that. And if that is in the price, then it's worth taking a punt and allocating capital to those situations.
Yeah, so in my sort of space of like small cap stocks, it's similar, but you have to be very careful in times like this. You have to look at the balance sheet of the companies you're invested in. You can't invest on narratives in the same way you maybe could in 2020, 2019. So a lot of people's savings are on the decline sharply. You're going to get less retail speculation and stuff like that. So when it comes to looking for decent small cap stocks, you really need to make sure they're funded or have really good sources of funding. For example, in an exponential stock investor, I tried to point to 3 stocks in our portfolio that have got ample funding. Luckily, they raised last year and they've got enough money to see them through 2023 and into 2024. And they're in speculative areas like biotech and sort of mining material stuff and some environmental technology. So they're growth stocks, but they've got funding secured to get them through whatever comes in the next 6 to 12 months. That doesn't mean the share price will be immune by any means, because these are still growth stocks that need to deliver on the promise. Otherwise, they'll get smashed. but at least they're not going to have to go back to market. So if there's small caps, I think you really want to be careful getting into narrative-driven stocks where they've not got a lot of money on the balance sheet, they've not got a lot of cash, or they're not generating profit, because the market, as things get worse and all this, all the speculative money exits the system, people just sell them at any price. And it takes a brave person to step in and buy a company that's got no money and is falling, 75, 80%. And that's not necessarily a good thing to do with your money either, because they can and do go bust. I've been in small caps for a long time, and there's delistings all the time, or companies turn into shell companies. It happens more often than people realize. It's usually just a slow death. And then in times like this, when there are economic and financial crises, they sort of enter their death rattle stage. And then next time, they'll be reinvented. Mining stocks become tech companies, small cap miners become tech companies, or reverse, small tech companies become the next flavor of the month. But by that time, all the shareholder value has been destroyed. And if you're left holding the bag on them, you'll lose a lot of money. So I would say if you do own small caps, be careful to understand what you own, look at their balance sheet, make sure they've got funding, or if they're making money, and some small caps do make profits, try to see if the sources of profit are sustainable even through a bad economy, stuff like that. So it sounds like a cliche, but focus on the risk of these things rather than the return, because if you get the risks right, and the company has a good story, these are actually great times for them to make great strides as companies, because all the competition's away, no one can raise money, no one can compete, and if they're taking a share of this fast-growing market, they've got the space to themselves almost. And as Greg says, think a few years down the line, they could be dominating in a fast growth area. So that's the kind of thing I'm looking for: fast growth areas, but companies that can survive come what may. That's probably the two sort of main things I'm looking at.
Yeah, and I just wanted to ask you, given your expertise in the small cap sector, are you seeing value there right now? Are you cautious? Are you cautiously optimistic?
It's selective value, to be honest. Just because a small cap stock's gone down 75% doesn't mean it can't go down another 75%. It can go down forever. So you don't want to, I wouldn't look at it as a sector thing. I would say generally the sector has been hammered quite a lot in the last year, even before the recent events. So generally speaking, that means there will be more pockets of value around. And as Greg said, tech's one that I'm looking at very closely, not just in Australia, but in America as well, because there's really, the arc of technology is not going to slow down much, no matter what happens to the economy. You look at some of the stunning advances in stuff like AI, which, that ChatGPT AI chatbot went from 0 users to like 100 million users in a matter of months. It was the fastest growth project of all time, based on word of mouth and Twitter. You know what I mean? Like, people forget how fast technology these days moves. So you don't want to ignore technology, because it will have a big part in our future lives. And if you can spot trends in technology at an early stage, bear markets can be great times to get positions that you just end up holding forever. You know what I mean? But you have to be very careful about the companies you're getting into. That's the sort of the trick, isn't it?
Yeah. I also just wanted to mention Bitcoin, because Bitcoin interestingly rallied quite strongly year to date, although it did fall a bit on the Fed's decision. So I just wanted to get your views on what's been happening with Bitcoin, and why has Bitcoin rallied so strongly so far this year?
So what the banking crisis has highlighted is there's several sort of fundamental drivers of value of Bitcoin that a lot of people ignore a lot of the time, because they don't think about how banks or money works. But what this situation has highlighted is the fact that there's no counterparty risk with Bitcoin. So at the moment, banks aren't even lending to each other, because they're not sure if the person's solvent, or if they can get their money back. There's a whole web of trust in the financial system, and when that trust evaporates, people are worried that they're going to lose money. With Bitcoin, if you hold it in your own wallet, you've got no counterparty risk. It's like owning a bar of gold and putting it in your safe. You own it, no one can touch it. The other thing that's appealing from that point of view is the sort of predictable inflation schedule. Like the amount of new Bitcoin created per year doesn't change based on the whims of a bunch of people in Washington D.C. deciding on it. It's predictable. It's fair for all. Everyone can see how much Bitcoin is being produced every year. It will happen on a predetermined schedule until the 21 million Bitcoin limit is reached. And so And the other thing is that it's accessible at all times. You know, the banks aren't open on the weekends. Bitcoin network is a decentralized network. Anyone can use it anytime. They can send value to anyone in the world in a matter of minutes for a few cents or a few dollars. As opposed to banks, which still rely, closed on the weekends, bank holidays, or overnight transfers and things like that. So it's digital money for a digital age. And if you put all that things together, these are all the things that are being highlighted right now. The fact that you've not got counterparty risk, the fact that you don't need to worry about what the Fed or the central banks are going to do, the fact that you can use it at all times. And I know there's a big venture capitalist in America called Balaji, his name is. He was a CTO at Coinbase, and he was a partner at Andreessen Horowitz, who are a famous VC firm. And he put a bet on on Twitter that Bitcoin would reach $1 million in 90 days, which is probably ridiculous. But someone of that stature doing it, if you look at his rationale for saying why he thinks it could happen, it's like I think he's a little bit silly to make such a prediction, but the reasons for it aren't silly. And he's been exposed to how beholden your money is to a banking system which could collapse at any minute. He's been beholden to the arbitrariness of it, the fact that people can pick and choose winners. And as a tech investor of his stature saying that, at the very least, what the bet does is it makes other people who respect him as a tech investor look at Bitcoin maybe through new eyes. And I think I said this last week, people think that Silicon Valley people would be all over Bitcoin, but they weren't. A lot of them were sort of attracted to the lure of making quick money from altcoins and other cryptos through different projects. And they neglected Bitcoin's inherent decentralization benefits as much as anyone else. And suddenly they've all done an about shift, and they suddenly understand why Bitcoin is so viable. So I think in that general market, Bitcoin should rise from here. Based on a hedge alone, you've got to remember it's still worth a tiny amount compared to the $400 trillion financial market. It's less than $1 trillion. It's still a tiny part of that market. But when you've got a banking system that's shaky, Bitcoin looks attractive as a hedge. And that's always the way I've positioned it, as a small part of your portfolio, just in case. But the upside of that is if more people think like that, the value of Bitcoin can get a lot higher. A guy that I follow, a Canadian called Greg Foss, who was a bond trader for 30 years, he puts a fair value premium on Bitcoin right now of about $220,000 US. And that's valuing Bitcoin as an insurance premium for the potential of the US dollar collapsing. So that's not saying that's the value of Bitcoin if the US dollar collapses. He is saying, well, what's a reasonable price to pay for Bitcoin as an insurance premium? So you don't think it will happen, but it might happen. And he, calculates that figure from using actual real world data in this market called the CDS market, which is a real financial market for valuing the chances of nations on this. So it's very small value, very small probabilities, but there is a market for that, which people use money. He says Bitcoin is probably a better form of insurance for that possibility than a CDS, because you've no counterparty risk, whereas with a CDS you've got counterparty risk. So the only last point I would say is the other big point of news this week was the China and Russia, and the announcement that Russia would accept the yuan, the Chinese currency, for their exports predominantly, and materials. That's a pretty big move. They'll accept it from anyone in the world, from South America, Africa, and it's an attempt. I don't know, or don't think it'll be successful, but it's an attempt to try in some way to displace the US dollar hegemony of global trade. But it's an interesting development because one of the biggest commodity producers in the world, Russia, albeit one under sanctions and whatnot, but you've combined that with the biggest manufacturer of goods in the world, China, and saying that you can now price stuff in yuan. I don't think that's necessarily a good development for the world. But again, if we're going to shift from the US dollar at any stage, I would rather, and I think a lot of people would rather, it went to a neutral system, which is what Bitcoin is, rather than just to the next empire that emerges in the course of global affairs.
Yeah. And Greg, I just wanted to get you in on this. Bitcoin is often called digital gold, but speaking of gold itself, what is your outlook for gold, given the markets are sort of predicting that yields are set to fall in the year ahead?
Yeah, well, Aussie dollar gold hit a new all-time high this week at over $3,000 an ounce. And the US dollar gold price is not too far from its all-time high either. So if you look at gold compared to digital gold, then gold is a lot closer to its all-time high than digital gold, which is neither here nor there, really. The way I look at them a little bit differently is that Bitcoin still has a very much of a risk-on speculative part to it because it's such a new asset and it's bringing in new people. And when there's liquidity, Bitcoin goes up, and it goes up a lot. And then when that liquidity goes, Bitcoin goes down, and it goes down a lot, whereas gold is just far more stable. It's been around for a lot longer, and I think it just has different investor base who's interested in it. But the fundamental driver for gold prices are real interest rates in the US. And over the past couple of months, they've been coming down, not dramatically. But I think just before the banking crisis, you had the long-term average real interest rate at 1.7%. And overnight, it finished at 1.5%. So real long-term rates are coming down. And that's been my case for why I'm bullish on gold, is that the rise in nominal yields and the rise in real interest rates is going to cause economic pain, and it's going to cause the Fed to have to change course at some point. Now, that might not happen for another few months, and the Fed is being very determined to stay tight until it sees inflation falling. But you can say that the market will look through that, and already the real long-term yield has fallen. I think it probably reached a peak. I don't have the numbers in front of me. It reached a peak probably close to 2% last year. And that was when the gold price bottomed, and that was around September, I think, from memory. So the financial system is going to move. The real yield in the financial system will move lower, I think, over the course of this year and into 2024. I think you'll see new all-time highs for gold, and gold stocks are not following those new all-time highs at the moment because their margins have been smashed by the real inflation that we've seen over the past couple of years. So higher energy costs, higher fuel costs, everything blew out for the miners. So there is a bit of a disconnect between where the gold miners are versus the price. But the fact that the price is now rising considerably is going to go a long way to rebuilding those margins. So I think, Aussie gold stocks are still pretty good value. They're very volatile, so you don't want to have too much of them in your portfolio. And, just the past couple of days, they've been moving around considerably with the gold price. But that's another area that I think, irrespective of what your views on the recession, the economy, all that sort of stuff, I think gold looks really good. And if I go back to 2008, gold actually bottomed around that time of the Lehman crisis. We had a massive sell-off after that. Stock markets, gold all made lows in November and had a big bounce. Stock market rolled over and made a final low in March of 2009, but that was actually the bottom for gold. So the way I look at it, gold does tend to bottom ahead of the financial markets, of the stock market and of the real economy, because the gold price responds to where the market sees future interest rates going. So the fact that the gold price is going up is another sign that the market is saying, Fed, you're sending the economy into recession and there's going to be lower interest rates down the track. It's just a matter of how long. And there probably will be a fair bit of volatility on the way to new all-time highs, but I think that's definitely something that is in the future for gold.
Yep. And I'm very conscious of the time. So I think now I'll ask you very quickly for any parting thoughts or conclusions that you may have.
None from me. I put all my thoughts in the past hour.
Yeah, I think I've said everything I need to say.
Exhausted everything.
Yeah.
Well, I just want to thank you both again for joining me for this live stream, and I hope the viewers enjoyed your insights. And if the viewers want to hear more, they can check out moneymorning.com.au or our parent site, which is called Fat Tail Investment Research. So I want to thank the viewers again and wish you a good day.
Thanks, everyone. Cheers, Kiryll.
Cheers.
See ya.